Good morning, everyone. You are watching a live market outlook for Wednesday, 23rd of November 2011. The highlights of today are standard from Europe, as France and Germany are pressing Eurozone treaty change in order to handle the current debt crisis in a better way. China's November factory activity slumps to the 32-month low. From United States, third quarter growth is cut on weak inventories, and President Obama pushes divided Congress to extend the tax cut. The stocks were down after China's news, economic indicators released during the night, and actually they're still blaming each other side in America after a failure of the super committee in order to cut the current debt. Now let's go to each subject one by one to get some more details. The French President Nicolas Sarkozy has embraced a German campaign for treaty change that could give European authorities more powers to intervene in the national budgets of countries that are sharing the single euro currency. And France and Germany will soon propose amendments to the European Union treaty in response to the bloc's sovereign debt crisis, Sarkozy announced yesterday. He said that with Chancellor Merkel, they will soon make a proposal on modifying the treaties to prevent countries from diverging in the budgetary, economic and fiscal areas. The treaty change in the EU is a fraud process. France has long defended its own national fiscal, economic sovereignty, and its voters actually rejected a proposed EU constitution in a referendum in year 2005. But diplomats said Sarkozy has little alternative now to going along with Merkel, because France's top AAA credit rating is now under threat, and the risk premium investors demand to hold French debt rather than German bonds now is rising. After a day when the borrowing costs of most weaker Eurozone economies continue to go higher, the President of European Council called for crisis measures, an apparent hint to the European Central Bank to make further action. Sarkozy also praised the ECB's role in buying limited amount of Eurozone bonds to calm markets, but refrained from calling for more decisive intervention, in contrast to his finance minister. The EU paymaster Germany continues to block the two most widely touted exit routes from the crisis that is shaking the world economy. The one is the massive ECB intervention to buy government bonds, and the second one, the joint issuance of Eurozone debt. Some policymakers from the European Central Bank said that they would reject the current proposals, especially the one of European Central Bank's action, as the European Central Bank does not have this in its let's call it job description. However, we will see how the latest agreement what effect will have, as the single currency as well as the British pound remained under pressure this morning, and posting again fresh lows after a brief consolidation in the past 2 days. The dollar is again higher, while gold is losing traction after initially regaining 1700 level and breaking slightly above. However, the gold now remains protected in the short term. That we'll see on our technical part, while crude oil came again under pressure after China's data released earlier during the night. Now from China's factory sector shrunk the most in 32 months in November's reading, as the new order slumped. A preliminary PMI survey showed released during the Asian session. This is actually reviving worries that China might be speeding towards an economic hard landing and fueling global recession fears. The steep fall in HSBC Flash Purchasing Managers Index PMI to 48 in November from and October's reading at 51 underscores Beijing's growing alarm over the health of the global economy and unnerved the financial markets already rolled by Eurozone debt crisis. The data is likely to boost expectations. Beijing might soon shift its policy focus from supporting selected parts of the economy to broader measures such as reducing bank reserve requirements nationwide or providing fiscal stimulus. From United States, as I mentioned, the third quarter growth, the U.S. economy actually grew more slowly than previously estimated in the third quarter, but the drawing down of stocks held by companies and firm consumer spending suggested output would likely pick up in late 2011 in the fourth quarter. The GDP grew at 2% annual rate in the quarter of July to September, as the Commerce Department said it's in second estimate that was released yesterday, but it was down from previously reported 2.5% and forecasted level at 2.3%. While the pace of growth was weaker than economists had expected, the composition of the report, particularly still firm consumer spending and the first drop in business inventories in nearly 2 years, set actually the stage for a stronger performance in the final months of the year. A deterioration in consumer sentiment likely had led businesses to anticipate weaker demand, with the consumer spending showing resilience, as analysts said, and have to rebuild inventories to keep the factories busy. From today's calendar, actually we have the full calendar. Today some of Far East countries already released there, as construction working done quarterly in Australia showed a strong growth by 12.5% compared to minus 0.1% the previous quarter and only 2.1% forecast, as well as HSBC Flash Manufacturing PMI from China dropping to 48 from the previous release at 51 that was already mentioned in our announcement earlier. Still to come today, the German flash manufacturing PMI that is expected to drop to 48.4 compared to 49.1 the previous month release, while German flash services PMI is expected slightly to decrease to 50.1 versus the 50.6 previous month release. From Eurozone also manufacturing PMI expected to drop to 46.6 compared to 47.1 the previous month release, while services PMI is also forecasted lower at 46.1 versus 46.4. From UK, MPC minutes of the last meeting are due to be released at 9:30 GMT, and the votes are expected as the previous time at 009. The next to come at 10 o'clock, industrial new orders monthly from Eurozone expected to drop by 2.4% compared to the previous month growth by 1.9%. And then a bunch of indicators from US Durable goods orders expected to further decrease by 1.1% compared to the previous month, decreased by 0.6%, while core durable goods orders are expected to grow by 0.1%, much below the previous month at 1.8%. Weekly jobless claims at the same time at 13:30 are expected to show slight decrease, increase actually to 389,000 compared to last week's release at 388,000. While personal spending and income from US are also actually the personal spending is expected to drop by 0.4% compared to 0.6% previous month, while personal income is slightly higher, expected today at 0.3% versus 0.1% previous month release. University of Michigan Consumer Sentiment due at 14:55 GMT is expected slightly to come at a higher level at 64.6 compared to previous month release at 64.2. Crude oil inventory is due at 15:30 GMT. Forecast draw of 300,000 barrels compared to the previous week draw at, of 1.1 million barrels. That would be all from today's calendar. And now let's take a look in the markets and see the latest 24 hours movements of majors and the commodities. As we can see, the euro remained within the narrowing range, forming the descending triangle limited by main bull trend, main bear trend line drawn from 142.46 and main bull trend line from 131.45. However, the outlook maintains a negative tone as studies are well below their midlines. The price action keeps moving below our main moving average of 20 days moving average on the hourly chart. Current attack below initial support at 134.44, which is the trend line support, looks for a test of key short-term support at 134.21 low that actually contained in past 3 days the dips as the pair consolidated the broader down move from 142.46 and the latest leg lower from 138.10. Loss of 134.21 is to open the next strong supports at 134.07. As I mentioned yesterday, is the Ichimoku weekly Ichimoku cloud base that contained actually dips during this year, and the break here to signal a fresh bear face of the pair and a significant extension lower. Immediate supports will come at as we are looking on the daily chart, will come at 133.60, which is low of 26th of September, also low of 7th of October. And this is actually the last barrier ahead of our key short-term support, 131.45, low of 4th of October. On the upside, the immediate resistance comes at 134.80, 135 zone, where also stands the 20 days hourly moving average, while only break above trend line at currently at 135.30 zone, and clearance of yesterday's high at 135.67 is the near-term bear pressure, and look for possible further extension, higher further correction towards the 136.00, 136.14 high of 18th of November, also 50% Fibonacci retracement of the downtrend from 138.10 down to 134.21. Only break above 136.14 would signal a temporary base at 134.20 zone, and might look for a possible revisit of levels close to 138. Otherwise, holding below this resistance at 136.14 keeps the immediate focus lower, as the 4-hour, and hourly studies are currently in the negative territory and looking for a further extension lower. However, break of 134.21, 134.00 is required to confirm. The British pound again is on back foot as consolidative narrow range movements within 136 and 156 and 156.90 was interrupted yesterday by a spike down to 155.81. However, the pair managed to regain the recent range, but gains were short-lived as the studies continue to point lower, and the current fresh weakness seen in the past 1 hour is now retesting. Actually, there is already extension below at to 155.70 with the clear break to open the next level at 155.41, which is the 12th of October low. And then we have the round figure at 155 ahead of 154.83 that marks a 76.4 Fibonacci retracement of the ascent from 152.71 to 161.64. As seen on the daily chart, the studies are firmly bullish and the downside remains favored at this point, with the possible full retracement and retest of 152.71 seen likely in the short-term period. The dollar yen is again back to the narrow range around the 77 zone as seen in the previous couple of months, after a bounce from a fresh low at 76.56 posted on 18th of November, spiked to 77.31, just short of the previous spike high at 77.50, which is currently the range extreme point. The subsequent weakness turned the pair back to the narrow range hovering around the 77 zone. Nothing much to say. Then the studies are in the rather neutral mode at this point, and the only break of either extreme point is to define the near-term direction of the pair. However, the wider picture outlook on the daily chart still maintains negative tone, as 90 days moving average is currently at 77.05, capping the current price action, and against the recent spike higher was capped by 20 days moving average, while MACD is attempting, it's already below the signal line and is attempting below the midline that would signal fresh resumption of the down move from 79.52, which is the spike, which is the high of the post-intervention rally from record low at 75.56. Dollar Swiss still in the sideways movements, holding within the recently established range. However, the picture is still holding more negative tone, as 92 zone as initial resistance remains intact for now. A 4-hour chart shows the bears taking control as the price continues to move below 20 days moving average, and the MACD is attempting below the midline, while the momentum is already below, and this keeps the downside in the near term favored. Retest of 91.05 and the key support at 90.83 low of 18th of November, where also comes 23.6 Fibonacci retracement of the ascent from 85.66 to 92.34, as well as broken trend line drawn from 85.66 low, weakens the near-term structure and keeps the downside favored for now. A loss of 90.83 would signal some stronger corrective action, and likely to open the next Fibonacci level at 89.8, which is 38.2% retracement. only regain of 92 at this point would signal the pair coming back to strength and refocus 92.34, and our targets at the upside at 93.13.38 as the daily structure still holds firmly bullish tone. The crude oil remains now under pressure from the fundamentals from China, as well as extending the recent sharp rally that peaked at 103.35. It briefly broke below 200 days moving average, our initial marker that maintains the current bullish tone, and the firm break here is likely to signal a stronger reversal of the latest 74.94, 103.35 rally, and to open the next support levels at 94.7 and then 38.2 Fibonacci retracement at 92.50. Holding above 200 days moving average as the current price action is supported by 20 days moving average keeps the upside in focus, and for possible retest of 100 as psychological level and extension towards high of 103.35. On the near-term action, 4-hour chart still remains, studies still remain under pressure, and the immediate 20 days moving average of 197.37 currently pointing lower is maintaining this recent weakness, while regain of 98.67 high of yesterday and the one of 18th of November at 100.28 is required to refocus 103.35 high. Unless loss of 95.23 also comes the 200 days moving average, might signal further reaction lower and extension towards 94.50 and at 94.50 actually, which is the break point in the short term. This marks the high of 25th of October and the low of 9th of November. Gold again in defensive after extending gains above stronger barrier at 1700, 1709, 1710 was seen so far. However, break below 20 days moving average on the hourly chart, as well as MACD already below the signal line, suggesting further decline as all studies are pointing lower, with possible retest of 1695 initial support and 1686 the low of 22nd of November. On the daily chart, the current the rally from 1532, the current bullish action is still I would say intact, as 50% retracement level at 1666 holds, and while above here there are still hopes for a fresh extension higher and possible retest of 1800 levels. However, the main drivers of gold are now the fundamentals, so developments in the current European and worldwide economic crisis would actually dictate the price of the yellow metal.